of the United States of America, to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Roll call.
Treasurer Beagle. Here. Governor Evershaw.
There a motion to approve the minutes?
Move approval of the minutes of this meeting.
Second.
Discussion. All in favor? Aye.
Aye.
Aye. Opposed? Motion carries. Joe, you're up. Commissioner's report.
Thank you, Governor, and members of the land board. I'll go right to my commission report on page 2. It's brief this month. Just two kind of events I want to highlight. One was the grand opening of the Theodore Roosevelt Presidential Library. We all know about that. I was out there for some of those events. My comments are, it's an amazing venue, very educational. It's going to be great for North Dakota. So, and then the big event we have coming up, we're hosting the National Association of State Trust Lands Conference in Medora, starting Sunday, July 12th through 15th. We have good registration numbers. We're looking to be about 150, which is, they typically range between 100 and 150. So we're going to be at the top end for this one, it looks like, so that's good. The big news story there is the heat. It just looked 108 to start on Sunday in Medora. So I was joking with some of the investment folks here that the people, that our friends from the southern states that were coming to hopefully get out of the hot weather are going to be sadly disappointed.
It's good for them to know that we're not under snow all the time.
Right.
Yeah.
And so they'll change their opinion.
Welcome to the extreme of the Batland.
Branding situation. I'll go home, never forget it.
Right. Yeah.
That's good.
So hopefully the ACs are working out. Okay, I will move on to the
Before you jump, I just want to mention, so I gave Joe something. So a week and a half ago, I was invited over to another association's kind of a smaller volunteer association, the Advocates for School Trust Lands. They invited me out there just to talk about our budget and how trust lands impact into our budget and everything. And so they recognized North Dakota for our commitment to trust and presented us with an award because they this national association felt so strongly about how well we were doing. So I brought that for Joe to figure out what to do with the Silver Platinum.
I'm not going to touch it because I think Thomas just wants all of us to get awards of the Ethics Commission for getting that gift.
Well, it's the board. It's I gave it to.
I'm not so sure. I think it was to
We
Thomas.
can send it back. I was sending it back.
Yes, Tom. Well, that was nice. That was nice.
It's not going to go to any individual we displayed in there.
I didn't know they were giving it to me until after I was done talking, and then they said, "Hey, we want to recognize North Dakota. Do you guys have a place for this?" And I said,
Get your talking points down. That's good.
Also tell you that it's engraved with us on it, so you know what its value is to anybody other than us. It's minimus.
Still on eBay. Find out.
"That is true."
No, it's very nice. Very nice.
Thank you. And thanks for representing us there.
Of course.
And it's good to be recognized like that. Any questions before we move on to financial dashboard? Okay, we'll pull that up. First page of that is 3 of the packet. You can see the Common School Trust Fund ended just under 8.9. So we're getting close to the 9 billion mark. I do anticipate we'll hit that in the next couple months here. So we'll be on the lookout for that. So we go to page 5 of the report, you can see our revenues for the Common Schools Trust Fund. Very similar profile to last fiscal year. See the investment performance is very strong again, very similarly. And then the other 2 revenue sources are, so it's almost looking to be almost like a mirror image of last year, which is good because we had a really good last year. So page 6, the SIF fund, there's a cash in the account of about 1.16 billion. Of that, the uncommitted balance is 150, just under 155 million. When you take into account the funds that were allocated by the legislature and by the for potential vehicle seats. And if you go to the SIF rev page 7, you can see again tracking pretty similar to last year on the investment and land and mineral income. We have not received any of the tax funds yet, which is in the next page. You can see the waterfall of oil and gas tax revenues. Treasurer Beadle usually has a little more updated information than that OB has put out.
So through the month of June, jumped that up another 75 million in the state general fund. Now in this month in July, we were just running the numbers yesterday. We're not only going to fill the general fund bucket, but we're going to fill the lignite, the remainder of the state disaster relief, and then looks like we should be making the first small deposit into the prairie dog buckets. So a couple $1 million will trickle into those ones. So we're cruising many months ahead of schedule right now, due to high oil prices, just been helping a lot. So, by that estimate, we should easily be dumping into SIF here when we get into Q4 if oil prices stay where they're at.
Great, thank you. And then the next page, you can see the total assets under board management, just under 12.5 billion when you count the value of the surface and the mineral acres. The next page is a new feature to the financial dashboard that we've been working on. And this, I think we're going to present this quarterly. And this is just a snapshot of where things are at. Think about it looking at a gauge on on your car or airplane or something. So what we did is we looked at past 5-year averages on these and that's where the gauge numbers are at. So for example, if you look at the royalties, bonus, and rent income, we kind of have averaged between 300 and 600 million on that per fiscal year. So if we're trending in that 400 to 600 million, we're probably on the upper end. If we're trending in the 200 to 400 million, we're on the lower end there. So that's kind of how we develop the gauges. And obviously green is better, red is worse. So you can see the Common Schools Trust Fund 5-year average growth. Now this is not investment return. This is total growth when you account for cash flows and investment return. So that's about 8.5% over the last 5 years. Royalties, bonus, rent income past fiscal year was just under 500 million, which again is in the green area. That's looking good. The 5-year average investment return is 6.62%. Just kind of in between a little bit of yellow and green there. We'd like to be a little bit closer to 7 or even higher, obviously. But so if you look at when Josh presents his performance report, that's still pulling in the year of 2022, which was down 20% from the S&P. If you look at our 7 and 10-year numbers, they're quite a bit stronger. So this 5-year number should get into deep into the green over the next couple of years, unless we have some bad markets. But still pretty right in line with where we want to be, especially when you look at the 5 and 10 or the 7 and 10-year numbers. Staff turnover rate, just a gauge of what's going on with the agency as far as retirements, pay, if we have competitive pay, satisfaction, those sorts of things. Was about 10% last fiscal year. So there was about 3 people when you look at the staff of 34. Unclaimed property claims, we were about 13 million. So that's very strong. And then when you look at our percentage of budget remaining, basically we're trending good there. We're projected to have about 5% of our budget left at the end of the biennium. So any questions on that?
It's a neat way to present.
Great. Thank you. All right. And if you have any suggestions for that, if you want anything else to take a look at, we'd be happy to try to add something to it. Okay, we will go on to our division reports. Surface, May and June combined here, 18 right-of-ways in May for 65,000. Had the same amount in June, but generated quite a bit more of 633,000. So actually 2 busy months. But again, it just depends on what the right-of-way is for, right? If we look at the next page, 12, the oil and gas royalties, we're at about 395 million for this fiscal year through May compared to 421 last year. So we're a little bit behind, but still a very solid year. If you go out to the bar chart there, the last 2 months, you can see that we have had a nice increase in the revenues with the price coming back from the price going up from the Iran conflict. I guess it's not a war, it's a conflict, right?
Excursion, I think.
So we're nice months there, over 40 million for both of those. And then looking, we just had a little bit of a sneak peek for the next month. The numbers weren't finalized yet for June, but I think it's going to be even up higher for June, so closer to around 50 million. So, and then we'll probably, we've seen the price come down now a little bit. So the next couple months after that, we'll probably see a little more of a lag there. Unclaimed property, if we go into page 14, month of May, 636 claims for $1 million returned. We received total reports of 465,000. And then for June, 730 claims with $1 million returned to owners. 124 total reports for 109,000. So still busy months, but we've been able to catch up. We were a little bit behind with first part of the year was very, very busy. We've been able to catch up a little bit here, so that's been good too. Any questions on the division reports?
All looking good.
We'll ask Frank, our CIO, Frank Michael, to stop up and present the investment report. Then he's got a couple of guests that he's going to hand it out to as well. So.
Morning, Governor and Land Board. Pleasure to be back. I have with me Josh Even from RVK, as well as Art Greenwood and Kristen Court from Fidelity Asset. So I'll just do the quick flash report. We'll go into a recommendation for Fidelity or bond strategy, and then we'll say goodbye to Art Greenwood. We'll jump into the Q1 March 31 report for market. So starting on slide 16 shows the snapshot report. Scrambled to try to bring the most current up-to-date June 30. So this is the June 30 flash report, very preliminary. This would reflect all of the public investment return estimates, and then as those months before the rest of those items. As you can see, the portfolio investment or investable assets reached an all-time high of 9.4 billion. They're on slide 16, and then with the slide 17 that shows the actual versus target weights. If you remember last board meeting, we did have the informational memo that we were going to rebalance, and we turned off the bond overlay. So I'll highlight on the public credit box and whisker chart here. You can see that blue dot is now within the maximum. Last board meeting, it was beyond the maximum. So we turned off that overlay and brought that exposure down for public credit. Let's see, last board meeting is as a reminder, we also topped up with a couple of infrastructure managers. That isn't reflected yet. Here's probably take a few months up to here before they end. On the next slides, slide 18 is the flash performance report. So we had another stellar fiscal year, it looks like, at about 14.5% return for the portfolio. That's led by the international equity book, 33%. Again, to reflect about just the public equity, fixed income, and hedge funds estimates, which represent about 60% of the portfolio. So we have another 40% of the portfolio in privates that could take some months to trickle in. I think once those numbers roll in, we could see our fiscal year to date number exceed 15%.
As we were all in Micron, we might be shooting way higher.
Yeah. Percent is
Right.
Let's see, next slide, 19 shows the uncalled commitments. No large changes there, mostly from the private equity book way to deploy that capital. And then no large changes here on the liquidity waterfall snapshot. Before I jump into the recommendations today, any questions on the flash reports? So today we're going to recommend an investment with Fidelity's Core Plus bond strategy. So right now in our core bond portfolio, we're indexed with
State Street one.
with the State Street Index. Yeah, and so the way we think about it is that's our most liquid and conservative part of the book, and the place where we're sourcing liquidity to fund private market capital calls. So we're giving up a lot of alpha opportunity to earn some excess return there. So we want to take a little bit more risk to try to deliver some excess returns with that part of the book. And so moving from indexed to active management. And it'll still remain a very liquid part of the book. It'll just move from passive to active.
Would we be looking at what our State Street was as in the last quarter? This would only be about 2/3 of that amount. So would you still be?
Yeah, that's right. So we've got about 900, 950. Then became about 300. I expect that we'll put to work over the next year. So I'll hand it over to Josh to give to start the recommendation.
Thanks, Frank. Governor, members of the board, good morning. Great to be here. I know you have our recommendation memo and materials, but I'm just going to try to provide a little context around the recommendation before my Fidelity tell you about how they manage money in the strategy. This is a small part of your portfolio. The policy target is 7%. And as Frank noted, we do want it to play a specific role first and foremost, which is anchor to windward, safety, liquidity. It is a pretty easy benchmark for a lot of active managers to beat, though, the way that it's constructed. It's highly oriented towards government or government-backed securities. It's very safe. As we went about this search, one of the most important things that we had in mind was we wanted to, first and foremost, still provide you those primary characteristics of fixed income. And a lot of active managers out there beat the benchmark by just always taking more risk. And that's not what we wanted, especially at this stage in the cycle. We're pretty late in the credit cycle. What we think could be valuable for your portfolios, if we could find a manager that has demonstrated some skill at managing credit cycles and not just always taking more risk. And we worked with Frank and his team pretty closely, our research team, to really kind of focus on that set of criteria. And that process led to a short list of managers, out of which Fidelity is our recommendation to you. So I think you'll hear some things about how they're positioned today for the current credit environment we're in, where you're just not getting paid a lot to difference relative to normal periods. But there's probably, and not probably, there is a period of time in the future that's coming where spreads widen out. And that's going to be an opportunity to deploy that capital at higher returns. You kind of need to be positioned to do that in advance. So that's really kind of the context behind the recommendation.
Well, good morning, Governor Armstrong, honorable board members. Thank you very much for this is a terrific opportunity. Also wish to thank staff and consultant for their generous recommendations. By way of brief introduction, my name is Art Greenwood. I'm responsible for relationship management and client service. I'm joined today by my investment colleague, Christine Thorpe. Christine is an institutional portfolio manager and a member of our Core Plus investment team. One comment on Fidelity that will echo something mentioned in both staff and consultants' recommendations. Just by way of reminder, Fidelity is a 100% privately held, employee-owned money management firm. And we think that brings a couple of important benefits to North Dakota as a business partner. One, we enjoy extraordinary organizational stability as a firm. And secondly, we manage the firm and we manage portfolios with a very long-term perspective in mind. So we're not subject to quarterly Wall Street earnings pressure. We're not subject to outside external shareholder opinions. And that's a really, really important position to be in to be successful on your behalf. So with that backdrop on Fidelity, let me yield to Christine for the investment story.
Perfect. Thanks, Art. And certainly thanks to the board for the consideration. I'll start us off on slide 28. I'll give you just a brief overview of our fixed income organization, talk a little bit about the team and the strategy, but certainly happy to entertain any questions. So our bond group is actually based in Merrimack, New Hampshire, just about an hour north of Boston. We've been managing fixed income assets at Fidelity since the 1970s. And today we manage over $2.5 trillion, which spans both our money market business as well as our investment grade bonds products. We also work really closely with our high yield team that's based in Boston and our global credit group that's out of London. So we use them to get their expertise on their respective sectors, since those aren't core allocations for us in the Core Plus strategy. We've been running Core Plus at Fidelity for over 25 years now. And over that time, we've been able to deliver really consistent alpha. So we've been able to beat the U.S. Aggregate Bond Index by over 90% around 90% of the time. If you look at our 3-year rolling returns before fees. And we really do that by leveraging, I'd say a very experienced group of portfolio managers, but also traders and analysts. But then in addition to fixed income, we got a lot of resources outside of that asset class. So Fidelity overall is a $7 trillion asset manager. Excuse me. So we've got a very large equity presence. So all of that is to say, we've got a massive research platform. It's got about 350 professionals around the globe. But that equity book also gets a lot of access to corporate CEOs and CFOs, which we really try to leverage for differentiated credit insights. And I'll just say, in addition to all that sort of focus on that deep sector expertise, that bottoms up fundamental analysis, we also think we've got a best-in-class approach to risk management, to our proprietary risk models, and then independent risk oversight provided by our chief investment officer. So with that, we'll go to the team page on the next slide. Since the early 2000s, we've used a team-based approach to managing our Core Plus strategy. So, under this construct, we're not relying on any one person. We don't have any key person risk, but we're also small enough that we can be pretty nimble and react to market opportunities. I'd also say across this team, we've got a really diverse set of experiences. So we've got some PMs on the team that were former analysts, some that had a focus on macro, and then others that had either a trading background or quant experience. So we just think that makes for a better debate team. And then, it's a very tenured team as well. The most senior members have over 2 decades working in the markets. I'll say this group really likes working as a team. That's a big part of our culture, but their compensation structure also backs that up. So the PMs are compensated in a large part by their performance relative to the benchmark over the long term. So we think that aligns their incentives with our clients. And with that, I'll go to the next slide, just to talk about the strategy. In Core Plus, similar to what you've heard, we're really focused on that competitive and consistent risk-adjusted returns over cycles. So, in any given year, we're really not trying to shoot the lights out. And I'd say we do that consistently by making really good sector allocation and security selection decisions. Again, just given all these resources we have at our disposal. So over a cycle, generally 90% of our alpha are going to come from those two sources. On the flip side, there's a couple of things we typically do not do in the portfolio, which can introduce a lot of volatility, which is something we don't think investors really want out of your fixed income allocation. It should be the sleepy part of your portfolio. So we don't take a lot of big interest rate bets, which can again, swing the strategy around. Durations typically kept in a pretty tight band relative to the benchmark. We do invest in some non-dollar exposure. It's currently about 1.5% of the portfolio today, but we hedge all of that back to USD, so we're not taking any big currency bets. And then finally, while we do have some limited use of derivatives, it's a very small part of the strategy. So not a big emphasis. And similarly, we don't take a lot of leverage. So think about this as being a very transparent and easy to understand portfolio. We can go up to a max of 30% in below investment grade exposures. Those are the sectors listed on the right-hand side of the slide. So think of high yield corporates, leveraged loans. But I'll say, in practice, we've never reached that max 30%. Typically, really the highest we've ever gone is mid-20s. And today we're at 16%. It's not really based on concerns about the fundamentals. This economy has been incredibly resilient, but just valuations have been so tight. And this is part of our philosophy. You'll hear us call ourselves gradual contrarians. So as the market gets more expensive, as we've seen over the last few years, we'll take risk off the table gradually and really deploy a lot of that usually into U.S. Treasuries. That's going to be a source of liquidity for us when risk assets do cheapen at some point and we want to go out and go on a buying spree. For us, we're never really trying to time the top or the bottom of a market. But really, that often means we're sometimes early, sometimes we're late. But in general, when there's not a big fat pitch in the market, we're going to be really patient and diversified and wait for a better opportunity. I'll just go on to performance just briefly on the next slide. Within the Core Plus strategy, we're aiming to beat the benchmark by 75 to 125 basis points before fees over the long term. And so when you look at our, even over the 1 year and longer, you can see we've been exceeding that target. But if you look at the middle of the page, that standard deviation, that's one way we look at the volatility of the strategy. And so, you can see over those longer time periods, the volatility of the strategy is right in line with that of the benchmark. So, you're essentially getting these higher plus returns with benchmark like volatility, which we think is pretty compelling from a risk-adjusted return perspective. So I'll just go to the last slide and wrap up briefly. But, question will go, why buy Core Plus? You've got a really stable and experienced team that you're buying, one that's incredibly consistent about sticking to our investment process. We don't deviate from that. We know what we do well, and that's leaning into, all these sector teams, research analysts to really drive our decision making. And we're going to pair that with very disciplined risk management to help us protect against the downside. Again, like I said, it's really transparent process and portfolio. So you know what you're getting. And we're going to be very measured in terms of when we're taking risks. And we're only going to do that when we think we're getting paid to do so. So think of us, to borrow a baseball analogy, we're trying to hit a lot of singles and doubles over time by really leaning into those repeatable sources of alpha, which we think delivers a more smooth ride for our investors. And then, of course, the proof of all of this is that long-term track record that we just saw on the previous page. Let me pause there. We're happy to take questions whenever is needed.
Questions?
Christine, not necessarily with the, I know you're not chasing the interest rate or anything, but that's been a topic of the conversation lately, especially the Fed funds rate, what might happen there.
Yes.
You guys have a lot more exposure to different areas, so you might have a little more insight. Kind of where do you see some of the headwinds right now? Because I see, some of the international pressure and some of the inflationary concerns starting to tick back up again. And so now, even with the new Fed chair, they still haven't signaled a rate cut. So kind of curious where you see headwinds.
Sure.
Headwinds to raising interest rates?
Or
Donald Trump.
Headwinds to the strategy.
Yeah. Well, I think just broadly on the rates picture, and even, Chairman Warsh, I think at this inaugural meeting, last month, came out a little bit more hawkish, certainly than the market was expecting. And it really is being underpinned by this, concerns over inflation. And I think, part of that is certainly driven by, the events in the Middle East and what we've seen in terms of energy prices. But, we've also had a very strong economy. We've got this massive AI spending cycle right now. So, I think there's a lot of other inflationary pressures in the environment. So, I think the expectation is we could be certainly in this higher for longer rate environment. But the nice part about fixed income right now is, yields on the ag, we're in the 80th percentile. So you're earning a very nice source of it. You're getting that nice source of income, which is also providing a lot of cushion, if you do get more price volatility. So if rates sell off further from here.
So on that, in the economic growth, the AI spend cycle, the CapEx expenditures that we've had over the last 18, 24 months have been insane.
Yes.
And not sustainable based off of the profit generation coming off of it so far. Now, every day, they're all expecting that to flip the corner and go, but I know that led to some concerns earlier in this year, specifically on the private credit side, which I know wouldn't be this strategy, but that kind of has some domino effects that could flow in. Where are you guys seeing that trend going right now? Is there going to be talk of CapEx coming down a little bit? I mean, some of the firms look like they're selling equity to try to instead of doing the debt side.
Yeah. No, we are not seeing any signs of the spending cycle slowing down. So, just to put it into context, we've seen AI, hyperscaler related issuance in the bond market of about 250 billion so far this year, right? And these deals are massive.
Yeah.
Amazon just did 25 billion. They've done 37 earlier in the year. And, we're expecting, perhaps another 90 billion so far this year. And by all accounts, we think, in 2027, we could see similar, if not higher. So I don't, this trend does not seem to be slowing down at any point. I will say as a bond investor, we're being incredibly cautious. These deals are oftentimes coming at very tight levels. At some point, we think there'll be some volatility and that'll be an opportunity for us to add. But right now, we're just going to be patient and again, wait for better valuations. At some point, the market may have trouble digesting a lot of this.
That spend is what's driving so much of the market right now.
Sure. Oh, absolutely.
So I made the tongue-in-cheek comment about Micron earlier with
Yes.
the report, because the people that are selling the widgets to the AI hyperscalers or the hyperscalers themselves that have driven the whole rally in the last 2 years.
Yes.
So
Yes. I think we do hear from our equity side, right? There's still so much demand.
Yeah.
So a lot of people will draw the analogy to the, telecom build out in the early 2000s. And, the difference there is, they were building the infrastructure before there was all the demand. So, but we'll see, it doesn't mean we may not see a few boom and bust here and there.
Any other questions?
comfortable with it.
Now we'll jump back to slide 21 and I'll.
Yeah, Mr. Chairman, I would move the board approve hiring Fidelity Corp Plus with the initial accounting size of 650 million, subject to standard legal review and documentation.
Second. Discussion. Thank you, guys. Roll call.
Secretary Howell,
Yes.
Treasurer Beadle, Attorney General Wrigley,
Yes.
Governor Armstrong.
Yes.
Mark, do you Jason Wagner at all?
I do. Yeah.
Say hi to him for me.
Oh, I will. Oh, thank you for calling him out. That's great. He'll be very flattered and appreciative. Yeah.
He's been a good supporter of our national association, so I've been on a couple of boards with him for this.
Oh, that's great. Yeah, I've known him for a long time. We share a common manager. We report to the same person. Thank you.
Thank you so much.
Thank you. Thank you.
Good job.
Catch you for.
Okay.
Thanks.
Thank you.
Thank you.
Thank you.
We'll jump to the March 31 RVK performance report. Start on 61.
Right. And I know March 31st was forever ago. here we are in July. Markets have advanced, equity markets at least have advanced since this point in time. So this isn't really about market at this point. It's really more kind of the most up-to-date scorecard that we have that captures most, not all, but most of your private markets updates. As you saw from Frank's report, you had a great total fiscal year. Bringing this most recent, it looks like you had about a 7% return last quarter, which brought you to that 40. But if you can remember way back to March on page 61 here, first quarter was actually pretty choppy. It was great for 2 months, and then the
Middle of February is unchanged.
yeah, things took a turn in the Middle East, and markets became frightened. And for the quarter, what that meant was losses in both stocks and bonds. And that felt a lot like 2022. If you remember back to then, Joe talked about that year being challenging. Both stocks and bonds were down that year because markets were really worried about rising inflation. And so you sort of saw some of that same type of market action again. But over the past year, you zoom out, even with that, it's been a great period for markets. A lot of it driven by this annual event you were discussing about. If you go to the next page, page 4, this was kind of a special chart that we put in here just to call out that there are some unnerving similarities between the current market and the 1970s. In the 1970s, you see the inflation line on the top half of the chart. Light blue is CPI through the 70s. And in the 70s, we had sort of this double spike in inflation. The first round in 73, 74. We now know that Fed made a policy mistake. They eased too early, and inflation wasn't gone, and it came back worse than before. And so that, and you look at we've overlaid on that the inflation for the period 2017 to today, and you can see some kind of unnerving similarities in terms of the inflation dynamic.
It's wild how close that track.
Yeah, and that spike up that you see at the end of the current line, that's the same thing from the 70s conflict in Iran.
Yeah.
Oil price shock, some other weird things. The Knicks are good at basketball again. Americans like soccer.
Yeah, we don't anymore.
Yeah. The last week.
Always so.
I'm aware.
So, and the scary thing about that is, as investors, is if you look at the bottom line, this is showing you rolling inflation adjusted returns for a portfolio of stocks and bonds. The 60-40 stocks, 60% bonds, 40% or 40% bonds, 60% stocks. And when you saw these inflationary spikes, you went through these pretty long periods of time where the real returns were below zero. So you didn't keep pace with inflation when this was going on. And so that's the concern. And the point of this chart is not to tell you that we think that this is exactly what's going to happen just because it's what happened before. There are some important differences. We didn't have game-changing artificial intelligence technology in the 70s. That's a huge difference. But the risk of this is certainly elevated. And as a board that allocates these assets, we think it's a risk you want to be thoughtful about. And you really have been. You've got some parts of your portfolio that actually are responding really well these periods. And it's partly why you've had, relative to most others, really good performance in 2022. You go to page 6. This just shows you the asset allocation versus your policy targets. Frank showed you actually a little bit more updated version of this, but big picture underweight equities, mostly because you're still building up to your private equity targets, and overweight fixed income in the meantime. If you go to page 8, this is the total fund performance at the top, net of fees. Like 2022, you actually did pretty well in this tough quarter that was marked by inflation concerns. markets were down, you actually had a positive return. You were up 21 basis points. I know that's not a lot, but this is like my favorite thing when this happens. The markets are down and my client has a positive. Something psychological about that. Fiscal year to date, you've got a nice advantage over your target allocation index, 7.2%. Had you been exactly at policy targets and earned exactly policy benchmarks, that would have been 5.8. And a little even stronger over the 12 months, 13.1 versus 11.3. That's 183 basis points ahead. So Frank and his team and the land commissioner's office, they've really done a good job relative performance here for you. As you go down the list, I'm not going to read through all of these, but if you look at your equity portfolios, you outperform U.S. and non-U.S. equities. And I'll tell you, this is a time period we are seeing a lot of good. There's so many cases right now that we're seeing good, high quality managers that are really just struggling. So it's really quite something that you've performed as well as you have in equities. And part of what's driving that is what's really struggled is kind of fundamental stock picking, and especially anybody that's focused on quality, like owning high quality balance sheets. You have a much more systematic, quantitative approach to investing with your 10-30-30 type extension strategies with some really good managers that have navigated this exceptionally well for you.
I'll just add a comment there. We have a weekly meeting with the investment team, and we've been watching our international managers just crush it. Every week we pull those returns up. It's just like our international managers outstanding.
So people who are trying to pick quality things are having less success, and we're picking lower quality. That's good, right?
And it's
That my takeaway.
it's companies that are jumping to 70, 100 times forward earnings.
Well, it's the way
Something.
the way that I would suggest that you think about it is a lot of portfolios are overexposed to a single factor. That single factor is quality. You have quality in your portfolio, but you've also got diversified exposure. So that's what's helped you to outperform in this market.
One factor that a lot of our quant extension managers use is momentum. And so that could be another factor where they're, basically, if the stock is going up, the momentum factor says it'll keep going up. So not necessarily low quality, but just different types of factors that they bring into their model.
That's interesting. How do you trim that though? I mean, obviously at some point, when it goes up, comes down or moderates at least.
Don't say that. We're going up. Straight to the moon.
What are the metrics by which you measure? Okay, now we've gone to the point where we need to recognize that won't go on terminably.
And I guess with momentum, it really is it's a trend following signal, and so it will get whipsawed, and they will lose money when there's a rotation, but then once there's a trend again in the other direction, signal.
They do tend to move pretty quickly, though.
Yeah.
As soon as things stop, they pick up on it pretty quickly. It's quicker than most other investors. But again, keep in mind this is just one factor, and they're building these portfolios to be really well diversified by factor exposure, and they're really careful to make sure that you're not overexposed to a single factor. And they own a lot of stocks, like they own thousands of stocks, and they're also in your portfolio short some of the stocks that their models like the least. What it really allows them to do is just focus in on the value is going to come from the stock picking that their model needs to, and around that, making sure that you're not overexposed to a single factor that can really be out of favor. But to your questions, I think it is worth noting though that if a manager can outperform by this much, they can underperform by this much.
Yeah.
We think you've got like the cream of the crop, the small group of managers that can do this really well successfully, but there will be periods of time where they don't. So we're not naive to that. As you go down the portfolio, I know, you asked about private credit, treasurer. We've got the updated marks, 1%, pretty boring return for private credit. It wasn't as disastrous as, everybody
Everyone thought the sky was falling.
feared it would be. Now, there are some like real pressures, in private credit, and there will be losses there. And I think some of the lending to certain software models are kind of a good example of where there's obviously going to be some pain. But we do think that a lot of the financial press headlines around this were a little bit overdone.
And I think it was overblown. Plus, it was mixed with about the same time retail traders were allowed to start playing in some of those games.
That's exactly
And
what happened.
retail traders do have patience
Yeah.
institutionally, and so they
Yeah.
whipsaw. So I think that was just causing.
And they created these sort of designed, thought of as liquid vehicles for retail investors to invest in. And we've, from the beginning said, that's a bad. So you don't have any of that liquidity mismatch in your portfolio. Portfolios you're in. The key to this is like, these are loans. They self-liquidate pretty quickly. I mean, they're, 4 to 5 years next. And if you never have to sell, and if you get paid back, it's fine. It's where you have other investors that want out that can trigger the manager needing to sell. And that's what you have in these retail vehicles. You don't have that risk here.
Well, and we have like one of the managers that we have has some of those retail vehicle exposures, and they were in the press Blue Owl.
Yeah.
But we're not in those vehicles that
That's exactly
we're
right.
talking about. So.
That's exactly. And as you go to the next page on 9, a little bit of a choppy month for the hedge fund book, the absolute return multi-strategy hedge funds. They were down about 20 basis points, so not a big loss, but a few of them did have some disappointing performance. But you had a couple of them that are a little bit more contrarian that balance that out. They are still ahead of their benchmarks by almost a full % on the fiscal year to date. Real estate is kind of slowly, I'd say very slowly, becoming more interesting and coming back to life. We're at least positive returns at this point in real estate. But the thing that has done well in that real asset space that you've been building out your exposure to is infrastructure. And I just think that this is a great market for infrastructure investing. I think you've got some great managers in your portfolio. Frank and his team just rebalanced to, make some additional commitments to your existing managers. And, it's a great time to be investing in energy infrastructure in particular. There's just so much demand for it. And so much need for continuing to build that out and to, build in energy security, and also the deglobalization trend and the need to have more robust, secure supply chains is also another great opportunity for your infrastructure investing. That was all I had planned to cover. I'll gladly take any questions that you have.
Any questions?
Thank you. Thank you. Josh. Okay. We're down to item 5 on the agenda, special projects. We'll look at the SIF assigned fund balance on page 88. This is something we bring to the board every year to designate a certain amount of the strategic investment fund that we need to hold in reserve for potential litigation issues or losses. At this time last year, the board designated $43,125,000 for the assigned fund balance. We're recommending by 10.7 million, about 10.7 million to $53,786,309. And this is related to the Continental decisions where it brought into some more parcels into the quiet title action that we have. So we have some more parcels that are involved now with potential litigation losses. So if you look historically, this is still a low number. There were some years where it was over 200 million based upon all the acreage adjustments that we had to do for the new wink survey. So a little bit of a bump up, but we feel like it's the responsible thing to do based upon the additional parcels we have now that are subject to litigation. So the recommendation will be at the bottom there to set that at 53,786,309.
Your motion,
And make that motion.
Second.
discussion? Roll call.
Secretary Howell,
Yes.
Treasurer Beedle.
Yes.
Attorney General Wrigley,
Yes.
Governor Armstrong.
Yes.
Thank you.
Okay, we'll move on to a litigation update on page 89. We have the MHA versus United States Department of Interior. We have a couple developments there. The U.S. filed a motion to dismiss its quiet title claim, which interestingly both us and the MHA Nation are opposing. And that is because we do both want a quiet title claim to be litigated here, so we get a final resolution. If that motion is granted, we still feel like there is the MHA's quiet title claim that we could all pursue to get to trial. So we are still anticipating there's going to be a trial that would start December 7th. If you recall, they had originally, the judge had really set a September trial date, but due to some scheduling issues, we are now looking at a December 7th trial. So next thing we'll be waiting for is the judge's ruling on this motion that was recently submitted. So any questions on that? Okay, and then if we go to the quiet title action that we filed against the United States based upon the Continental Interpleader decisions, basically we have another extension there. So the federal government has until July 29th now to file their answer to our complaint. And we're okay with that because it's really complicated. The government's having to go through dozens of individual parcels along the river and determine how they're going to answer the claims that we brought. So should have more of an update for you that on in the September meeting. Any questions on that one? Okay. We do have a recommendation to go in executive session to look at an acreage adjustment on gas lease issue. So the board, if you open to that, option 92.
And there it is, Vanish. Question about the authority in the North Dakota Century Code sections 44-04-19.1 that the board close the meeting to the public and go into an executive session for the purpose of attorney consultation regarding acreage adjustment, oil and gas lease, the lease issue. Second.
Discussion. Roll call. I have one discussion. How come this motion is so much shorter than the one on the
I know.
Industrial Commission? I got to read for like 4.5 minutes.
It does take a while.
All right.
Secretary Howell,
Yes.
Treasurer Beedle.
Yes.
Attorney General Wrigley,
Yes.
Governor Armstrong.
Yes. The executive session will be recorded, and all board members are reminded that discussion during executive session must be limited to the announced purpose for entering into executive session, which is anticipated to last approximately 20 minutes. Board members, their staff, employees of the department, trust plan, and counsel with the attorney general staff will remain, but the public is asked to leave the room. This executive session will begin at 9:54 a.m. and will commence with a new audio recording. When the executive session ends, the board will reconvene an open session. All right. The executive session has ended at 10:26 a.m. and the public has been invited to return to the meeting room. The state did not take any official action, but the board did consult with attorneys regarding a legal issue, and there is no need for a vote. Next meeting is September 24th, 2026. Anything else for the good of the order? I gave you guys an hour and a half. You don't have
Seems like a long time for you.
to play hooky and go get Pearl's brunch.
There we go. Oh, good.
All right, Richard, I gotta get some new fat over the old pull.